Good afternoon, everybody. They thought I wouldn't make it. Day 96. We're back again. Today, I woke up actually very, very early, around 6, I think. So I've been up for a while. I didn't want to trade the London session today. I believe most of my wins have come from the New York Open. So I wanted to skip the London session altogether. I basically haven't looked at the markets. I've only looked at basically one pair, like had a quick scan, maybe literally 3 minutes on the markets. So I haven't really analyzed any opportunities. And the reason why I even was waking up so early is because I remembered that there's going to be, well, there's meant to be news. Excuse me. The problem was, it was for AED-JPY number 1, number 2. I was up for this, which is tomorrow. But it is what it is. So we're just going to go through the markets again, look for opportunities, and then we'll go from there. So yesterday, like I said, literally almost to the T, we're bearish overall, but I expect price to be bullish in the short term. Why? Because of the fact that we are closer to imbalances. And we even have this, if you go to yesterday's session, part 1, we'll explain that. And then obviously we have this, I just loaded it now, which is the note section, of which we had bullish ideas and we had weekly bearish ideas, sorry. And you can see we have more weekly, sorry, I keep saying the first line of the bearishness. We have more bearishness or bearish ideas or bearish confluences than we do bullish. And the bullish ideas are all short term. For example, near this 4-hour order block right here, which would be a bullish idea. Of course, since we come back into it, we then also have these imbalances that are near price. In fact, we didn't reach this 4-hour order block over here, and all these different things which could warrant price going up, but they are all based on the short term. And then you look at the bearishness, it comes from the weekly idea. And one of the things that ICT mentions is that you got to start from the weekly time frame and then see where you are on that weekly bias in the grand scheme of things on the daily time frame. So, for example, you are bearish, let's say on the weekly, you may be following up or aiming for liquidity to fuel the downward push. So on the daily time frame, you may actually be moving upwards. So that's the kind of key with price or tape reading and price action, is that you got to look at it within context. When you have context to an idea, it helps you shape when that idea is going to take place. So the bullish ideas are all short term, okay? Bullish short term. That would fund the idea that we had yesterday. For example, we had buyers on USD CAD. We had 3. I don't know where the third one has gone, but that was a different kind of. It's actually there, right? Yeah, it's actually embedded. Oh no, that's just the Fair Value Gap. So we had. Oh no, there's 3 here. Apologies. So we have the order block original. This should have been over here. We had this limit set, didn't reach the midway point of the order block. We then had this idea. We entered on the demo account, which is just simply a reaction from the 3-minute order block, and then a Fair Value Gap. We dipped back into it. We would have liked to have entered around about here, but with spreads, we got in here. It was 1.86. That's why I didn't enter it on the live account and only the demo, because it was a very short-lived reaction. Then we see price deliver to equal previous high, right? So that's what we had. You see then price come all the way back down here to our entry, and then it moves up to create another high. Sweeps that, displaces down, comes all the way back to this 3-minute order block, which is interesting how this 3-minute order block seems to be so powerful. But either which way, price comes back to it and then goes back to equal highs. It reaches this high later on over here, and then of course continues going up, as you can see. So that was the general idea, which is backed up by the short-term bullishness of DXY. So we've pretty much had this idea since last week. We've been watching it since. We haven't, traded it other than that one period of time. Well, we didn't actually trade it at all even, but we had the idea on 4 different entries, because there's actually another one I didn't show you, which was like a continuation of scalp type of trade, but I didn't really want to enter that. Nevertheless, that is the idea that we had for USD for a while, USD CAD at least, and it would have been backed up by DXY short-term bullishness. So whenever I'm trading with a short-term bias, my trade will not be held long term. If I have that's why context is important. If I'm entering a trade based on long term bias, I have the means and the evidence and the legislation or legal authority based on my strategy to. When I say legal authority, I'm not talking about in the court of law. I'm talking about within the realms of my trading style. I had the legal authority to actually hold for the long term and target long term values or levels of price. So, excuse me. Now that those ideas have been kind of established, you could expect a little bit more from DXY to move upwards more, in the sense that we haven't come up to this optimal trade entry, which would be perfect for the area of where price should start going down. But it is very plausible that we've pretty much filled up most of this weekend imbalance, and it's very plausible that price comes down from here. So if we are going to be bullish, it's going to be very strong on the terms of price action on the pair, wherever we're looking at. And then on top of that, we also have to keep in mind it will be short term, and we will be eventually looking for bearishness. So I am bearish, excuse me, for USD overall. But again, like I said, short term we are bullish, and then of course I would expect price to have that optimal trade entry to start moving down for DXY. Okay, so GU, you can see this is a fair value gap right here. This is a 2-hour order block. This is from NFP last week, Friday. We've just been coming up pretty much this whole time. And that's also plausible. Why? Because when you have such a big move like this, you would need some form of correction, generally speaking. So that whole of last week was pretty much that. Now that we're in a new week, we can start expecting something to happen. So this 1 hour fair value gap that we got from the NFP, we are in the midst of it. We filled up most of it. You can see here from that point, we've had this market to shift. Price pulled back to this area here, which would have been a good entry. And then it came back down to these equal lows, pushed all the way back up here to around optimal trade entry, the 7.9, in between 7.9 and 7.5 level. Can get rid of this for now. I don't like this. So the dealing range from this high to this low is as such. You then obviously have a smaller leg here, but I would have been careful of entering that on a re-entry. We can see that when we came up into this area, there is, I guess, a 5-minute area of fair value gap right here. Price tag that. Then this new dealing range, which broke this low, we had following the touch from this 5-minute fair value gap here. And then we broke this low right here, which is a swing low, and we look to be retracing. Now, when we are retracing, we can see by the red arrow, we would like to come to an area of interest. So the area of interest is an order block or a fair value gap. Since we've already established or already executed the creation of a new lower low, let me just make this green. We would be looking for zones around this optimal trade entry. So from the 7.9 to 6.2 level here. What do we notice? So there's nothing here, nothing much here. There is a fair value gap here, but that has been fully filled. When something's fully filled, I don't really like to use it. So then we have another level right here, which is area of imbalance. Should also be orange, actually. Yeah, change this to orange too. So this 3-minute fair value gap lines up with this 3-minute order block. Okay, so I'll be expecting price to come up this area and then start to distribute downwards. So wherever I enter, my stop loss will pretty much be below or above, that order block. This wick right here is, or actually above this candle, which is 3.6, and then add it maybe to about 5 pips. First target over here, of course, and then I'll ideally be targeting down here. So this will be a short-term bullish idea on the dollar. Obviously bearish on GU, but bearish on the dollar, since we'll be selling. Sorry, not bearish. Bearish on GU, but bullish on the dollar, which lines up with the bullish short-term bias we have for DXY. So I'll be expecting for price to come up to this optimal trade entry. If I get in here, that's fine. Another kind of area where you can enter is you could enter on the first touch of the order block, which would be right here. Low-hanging fruit. And then, of course, the best entry that I've found as my favorite is the midpoint of the order block, which is right here. And of course, gives you the most risk reward ratio. But I like to aim for low hanging fruit. It gets you in a trade, and it's better to forget about it after a while, because you can just simply just set a limit, for example, and you're good. Then of course your target will be down here. So this is one idea right here. I'm going to put in active trade just because I might set a limit, and it's just essentially the setup that we've just established here is just simply a, what's the word, when something's inside of something as a layer. There's a specific word I'm looking for. Not kaleidoscope. It's like you're scaling the strategy down a size and reestablishing it as a greater superior authority in a way. That kind of doesn't make sense. So this is what we would use to find out where we want to enter, right? So we would wait for this to happen. Right, this is the entry model, right? So the entry model we used on a larger time frame to figure out where. So you could see that it's a scale, it's like a repeatability or scalability is repeated. For example, in larger time frame, what is the move? So the move is that we could probably start on daily with this, right? So on the daily time frame, we had this swing low right here, displaced, retraced. We want to go down, right? Pretty logical, right? We took out the swing low. Although we create a high on EU, we create a lower high, so it's a divergence. So we took out this swing low with a displacement. We came back up into that displacement, and we're now trading from that displacement that it retraced to as our sell, right, to the equal lows down here. So that's our daily bias. Then we scroll down to the 1 hour, right? You see that high formed again, higher high, low. What happened? We took out that swing low again on the smaller time frame, and we did it by and via displacement. And what happened? We retraced back up, and you'll see that this is the 1 hour fair value gap, which we've drawn by these maroon lines. Price came up to it, and we are selling from it towards lower lows. Okay. So we see that exact shape on the daily time frame is also present on hourly, and it's also interesting is that it happened here and it happened here on the smaller level. Okay. Then we scroll in even further. What do we see again? Almost the same. These highs are equal. So equal highs. This swing low right here, taken out by displacements. And what happens? Price pulls back to that area of displacement. And then we sell to equal lows. And so what do we expect now? Well, we zoom in even further. We have these highs. We then take that out via displacement, pull back, and we displace. And guess what's happening again? You can see the same thing from this perspective, from this high and this low. Make this the swing low right here. We trade below, so these highs, we trade below that swing low, over here, come back up to this fair value gap, and we sell off from here. And then what we're now doing again is the exact same thing, but on the 1 minute, 3 minute. High, swing low, taken out via displacement, let it pull back, we sell again. So you'll notice that the same thing is just happening over and over again on different time frames, but in different places, over and over and over and over again. This is what happens when you get good at trading. It becomes a pattern where you can literally log on and see it like this. Bam, 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 bam. It doesn't matter the time frame, it doesn't matter the pair, it doesn't matter what instrument you're trading, when you're trading it, what country you're in, when you're looking at it. You will see this pattern form over and over and over again. And that's the best way to practice, is to see it happen over and over and over again. Why? Because when you see things happen over and over and over again, you get better at seeing it over and over again. It's called practice. It's called practice makes perfect. So I'm really liking this idea. Like I said, it lines up with the short-term bullishness or bearishness. No, short-term bullishness of DXY. And of course, we've shown the different, there's a word I'm looking for. No, let me give it the onion. Yes, perfect. It's not the word I was looking for, but it fits perfect. Recursive is also quite good. So I like it recursive and nested the best. Nested is what I'm looking for. It's not the word I was looking for, but it's the definition is what I was looking for. In fact, let me find. There's a specific word that I had on the tip of my tongue. Maybe if I do this, I might find it. But just give me a proper website. Grains. We'll just go with what we have. Nested and recursive. So it's a recursive idea. It's a nested idea where we're seeing the same thing but on a different plane. The plane there is just the time frame. So daily, we showed you for 1 hour, 15, 5, 1, 3. Like it's all happening again and again on different time frames. So this is the swing low, displacement. We're expecting price to come back up here, which will be where we enter our sell. So the next thing to do is to set a limit, and you need for that a pip calculator. Now this one has failed me on some pairs, but for the most part it is pretty consistent. And then we have our journal. 5 pips. Let's make it 6 for spread. Okay, 175 on this account. So price. What's price? 4193. Probably even go up to 7. 0.7 loss. Stop loss. 34243. What? Okay. Placed that sell limit. So the next thing you want to do is journal it. I like to journal before I enter the trade. Also need to update that. So for reference, this account started off at £25. I need to update this because I didn't add all my trades yet. But I invested £25, took it to 250. We lost to 150, and then we're gonna do our best to take it back up to about 300 this week. 300 should be achievable, to be fair, by tomorrow. Today is Tuesday, so by tomorrow I expect to double it, and then by the end of the week I want to be at minimum 500. But between 500 and my target is a K. I want to get to a K because, yeah, 2K is actually my real target, because if I took it to 2.5 1 week, next week find break even loss, next week again 10 exit, so 1.5 is our target. So anyway, 150. Let me just log this trade. So this is GBP USD. I'm gonna show you how I log my trades on my website that I created. Link in the description. So wait, what? This is the 5 minute, right? Me first scan this. So the one tool that is quite cool is that you can scan the screenshots like that, and it will input the data for you. You just click apply, and then of course everything will get calculated for you. The pip distance, you can see that we have 5 pips here and it's 5 pips here. Gives you the risk to ratio 5.66, and it's 5.66, so it gives you everything perfect. The only thing you may need to edit is the auto thingy calculation. I put in and I risk this amount, and then this will be where you exit the price, and you can choose your account strategy. This is New York session. It's a short. I'm not going to add any tags for now, but I am going to add screenshots. So this is the 5 minute, which shows you like so. And then I can paste that before 5 minute. Bam. Yeah, I need to update that a little bit. Okay, that's that. Then the hourly. I like to get multiple time frames just so you can see the overall gist. When I want to then go on, it's actually 2 hour. When I want to review, it's just helpful. added in the 3 minute. Join the 3 minute. Oh, it was a 5 minute, that's why. You can do 3 minute. You can show the daily balance, sure. Do it without the drawings. This bit. Let's see. You can add tags, maybe. Add nested idea. So just gonna put nested. Boom, 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 and that's everything. Save trade, and it's a live trade until I close it. Or you close it. You can then obviously review and edit and annotate. But yeah, I'm working on that in a bit. Cool. So that is this. I find doing it from here is what? If you leave site, what happens? Oh, it just closes it completely. Interested, didn't know that. Okay, so that's first one. Obviously, we just only analyzed one though, so let's actually move on. GU edit entered. So I like to start with the trades we were trading last time. So this is one that reversed on us. I think we came out right about here. It didn't reach our target of this low right here until later on, where it happened around probably end of market. So that would have been spreads. So yeah, but we closed a bit early. We kind of saw momentum fading when it was retracing against us. I didn't feel like price was going to deliver to where we were targeting, so I just closed the trade. With this, we were bearish from the touch of this large term. I think it's an order block, and we had the market shot to shift, not break, to the downside. But now it looks like again we want to be bullish, so I'm going to drag this down to the watch list for now. I'm not liking it. ADNZD, something similar. This was like a low risk trade. I think we were £7 from our trading account, which had like maybe, I don't know how much in it. And it was just a very long shot idea, 1 to 33, just based on the fact it was a 4 hour order block. I just thought, 4 hour order block, midpoint, it's going to be strong. There's going to be some reaction. And if it's not going our way, we would just close it, or we'll just lose money and it's fine. We'll just risk a small amount, but it's a 33 risk to ratio. I did think it was going to go down. It's the truth. But that just didn't work. Guess order blocks are only valuable when respected in context. So this is a 4 hour value gap, which we've touched before, created this kind of market structure shift. We are now market structure shift upwards in pushing back up to it, created though equal highs. And whenever there's equal highs, just know that the institutions love that. The reason why they love that is because it is going to be deemed as a area resistance for retail traders, and with them thinking that, they're going to be believing that to be the more touches, the better it is. The more touches, the better it is for a liquidity sweep. So when that does happen, expect some big movements because there's a lot of orders that were there. So when I see this as a very good target for buys, and I also see it as a very good place for prepping of sells. Now, as you can see, though, we do have technically a entry model triggered. What does that mean? That means that we've had a displacing and taking out a swing low. And then, of course, I would have been looking for re-entries around this optimal trade entry, these green lines right here. However, as you can see, not only did we not come up to it, but I'm not also interested in that. Why? Because it didn't do anything. It just created equal highs. I always need an occurrence to happen before I trigger my entry model. So an occurrence would be something of the sort like, yes, coming up to a 4 hour fair value gap, or like, yes, coming up to a 4 hour order block, like, yes, having a liquidity sweep. Now, it technically did come up to a 4 hour order fair value gap, so I can't just say it didn't do anything. But the reason why I would be careful is because of the fact we have equal highs. For me, my best event occurrence, or my favorite, I should say, event happening is going to have to be a liquidity sweep. The reason why is because a liquidity sweep is something that it is targeted at. It's targeted at taking out retail traders, and because it's targeted at taking out retail traders, it gives me personally more confidence. Because when price is pulling back to a fair value gap or is on order block, there's 3 different things. So an order block is order flow, is where institutions re-enter the markets. Let's say they're already in sell, price comes back up to an order block. Institutions get in at that order block, right? It's institutional order flow. So that's almost like their example of a support/resistance. you then have the fair value gap, which is price or the algorithm repricing the market. And the best analogy for this, which is the best way I can explain it, is when you are painting a wall. And if you don't have this experience, watch a video. When you're painting a wall and you start with a lot of paint on the roller and you paint, let's say you're starting from the top to ceiling to the floor of the wall, right? You start from the top, you stroke down, pull the roller downwards. You'll notice that you'll start running out of paint as you go lower. Now, you may not need to actually do this to really see or understand it, but you may logically be able to process this. So you start from the top of the ceiling or top of the wall and you start dragging the roller down. As you get further down, you're going to get more patches because you're running out of paint. The paint is being left on the wall as you go down. So the quicker you go, the more you'll realize that there's bigger gaps. That's what's happening when price moves down like this. Price is only being offered in one direction. So sales or sellers are being, or the prices offering for people that are selling the market. So the buyers not really getting opportunities to really get in. So what price will do, like that gap, is to go back to those moments. And what is the best way to fill those gaps, is to go back to those areas. So when you're painting the wall, going back to that analogy, and you're stroking the paint or you're pulling the paint roller down and you see those gaps, the way you fill it is by pushing the roller up, right back where it came from, and then you'll start to see those gaps being filled back up. That's the best way to fill it. Of course, there's other ways, but that's the best way. So what's that meant to be? So the fair value gap is a repricing of price or reoffering of price to buyers or sellers. Obviously, if it's a downwards or bullish, bearish or bullish fair value gap, you have order blocks, which are institutional order flow, and what is liquidity sweep. Liquidity sweeps are, or we take out buy side or sell side liquidity, which is where we are taking out real traders, retail traders. Taking out retail traders is a philosophy that they have collectively on falsified ideas. And it's not falsified in the sense that it doesn't work. It works. Otherwise, why would they ever believe it? It's like a gambling casino, right? You can win a jackpot. You can win millions, you can win thousands, you can win more than you lose. It's possible, but the odds are never in your favor. But there has to be some form of possibility. Otherwise, if there's no possibility, then people will walk away and only the crazy ones will be left. So because it works, like you can see here, if I was a retail trader, I'm selling it every single time it came here. 1, 2, 3, 4 opportunities for me to make money. And if I was selling to like this or buying this, buying, I'm selling to equal highs and selling. You could make good money from that. You literally, this move right here could create a millionaire straight. And what's the point? The point is that it works, but it's flawed. It's flawed. Why? Because it works less times than it does work. Sorry. The reason why it works less times than it does is because the odds are never in the favor of the person that doesn't know what they're doing. That's a bar right there. I didn't mean to say that. The odds are never in the favor of the person that doesn't know what they're doing. Yeesh. And I'm a person that always need the odds in my favor. I don't care. I always aim, no matter what I do, for odds to be in my favor. Now, even if I'm entering a place of impossibility, I'm going to gather as much odds as possible. It's impossible, or at least from when I was 13 and I was introduced to the markets, it seemed impossible to make consistent money. But what did I do? I gathered information, I watched YouTube videos, practiced, back-tested, tried this strategy, gain understanding. What does that mean? This person comes with a new theory. What does it mean? What are they trying to say? This person does this way. Lambo Royal, Swaggy C, Forex Alex G, Wheels FX, ICT mentorship, and there's other names that I can't really think of off the top of my head. I remember their faces though. So what's my point? Oh, what's that guy that's tatted up? I forgot his name. But anyway, what's my point? My point is that as soon as I entered, it was 0% chance of me succeeding. And I fought to find as many little percentage of gains I could put in my favor as possible. Whether it's 1%, whether it's just reading a candlestick, what is a line chart, what's a bar chart, what does it mean, what's different time frames mean, everything I could get. And now the problem with that when you're young and doing that is that you get information overload. And that information overload does more harm than good because it convinces you that you know what you're doing because you have so much information. You feel like you know everything. It's like a teenager. When they start to grow a little bit of hormones or grow a little bit of size and stature and experience, they now think they know everything, but they don't. They know nothing. And so similar to that was how I was like when I was first introduced to the market and started to gain the edge. And because the numbers aren't explicit, the thing about casinos is that you know the odds of the game winning before you enter legally, not because they want to tell you, but because they have to. But they may put it in a kind of vague way, or you have to maybe do some calculations, right? It's not saying you have a 49% chance of winning, but they'll put 100 options and they say you can only pick 49, and that means there's 51 against you. That's the roulette table. No matter what you pick, there's going to be more against you than there is going to be for you. That's the idea of a casino. And so with the trader markets, you never get that explicitity. You never know. Even when you back test, it's not the same, because live testing is very different to back testing. Live testing is not really testing, actually. Live trading is very different to any form of practice because real money is involved. And on top of that, there's no explicit definition of what your win rate will be, whether you will succeed or not. There's no definition. Because there's no definition, there's so much uncertainty. Your confidence has to come from somewhere abnormal, almost like that of a gambler, in the sense that a gambler, they get their confidence from just being lucky, or they just feel like they have a feeling. We get our confidence from knowledge, but the knowledge doesn't grant you success. The knowledge just gives you knowledge. It just does its job. It's like a person that's trading, and they're like trading, bartering, and they, or like a bartender, let's say, and they only care about you buying you alcohol. They don't care whether you're drunk. They don't care how much you have drunk. They're just there to sell you the alcohol. Why? Because that's their job. They don't get paid for anything more than that. Now, of course, some places and good places will turn off the tap on a person, but generally speaking, like let's use a vending machine. A vending machine don't care not how fat you are, doesn't care how skinny you are, doesn't care if you're starving. All it cares, put in the money, tap your card. These days they have tap contactless now. Insert your coins, tap your card, and the drink, the food, the crisp, whatever it is in my vending machine will fall. And I don't care what it is that's in my vending machine. You press the number, the item that I'm holding in that number will be the one that goes forward and drops, and you can pick it out. And the funniest thing is that the vending machine, it doesn't even help you pick your stuff up. It just chucks it down on the floor. Whether you want to take it or not, it's up to you. The vending machine only cares about one thing: tap in your card, and I will give you, or I'll push out the product that is in the number you type. So similar to that is the knowledge we gain in studying the markets. The knowledge is just there simply to do one job and one job only, to give you knowledge. That knowledge is not telling you to go and trade. That knowledge isn't telling you to go and make money. That knowledge isn't telling you that you're a winner. That knowledge isn't telling you that you're good. That knowledge isn't telling you how much you will win, how much your win rate is, what percentage it is. It's not telling you nothing. It's just simply giving you knowledge. And it's up to us to come up with the idea of those things I mentioned. How successful will we be? How successful are we? What is our win rate? We have to decide that. And when you are the one deciding, there's no one holding you accountable. The only person that can hold you accountable is the live markets. Because live markets, this is how it holds you accountable. Your money will go up or will go down. That's the only two things it does. Very strict it is. It doesn't care about how you're feeling, doesn't ask you how your day is doing. But the only thing it will tell you is, here you go, here's some money. Or it'll be like, give me your money. That's the only two things it says. And so it's very interesting how those two words can simply direct you in such a mighty way, in because just from saying yes, no, or just from giving money, taking away money, you can learn so much. Because when you lose, you say, okay, I did something wrong. When you win, okay, I did something right. And it's about just consistently going through that process. That's what study mode is for. Anyway, enough waffling. It's coming up to time when we need to find entries. Right. So we're on the 4-hour Fair Value Gap. Although I just said nothing happened, something did happen, is that we came up to 4-hour Fair Value Gap. I do believe that this will be liquidity that's going to be targeted eventually, but we did take out this swing low with a displacement. Now you need to be contextualized in terms of what leg you use. Why am I using this leg and not this leg? Now, albeit I will agree that I do need to improve on that. I cannot give you a definitive definition yet, but I'll tell you what I do for now. Right. For the first point is that I am relevant to the time frame. I look for the most extreme swing high on the time frame of 15-minute, which is here, and the most extreme low, which technically is down here, but I'm talking about the leg, right? So it's the one move, and it's just kind of a feeling. I don't know how to put it into words. I don't have like I said, a definitive definition. So if I was to meant to code this idea of strategy, I actually don't know how I would describe it. Maybe I'll say time-wise. I don't know. There's no definitive definition. One of the good ways would be time. That, okay, today the 15-minute low is this, and that, I mean, if I was to go down here, this is now last week Friday, which is not the current leading range. So I guess my definition will be somewhat linked to time, but I don't have that right now. But I use multiple and I use it within the context of the time frame I'm on. So this is the displacing leg, which took out this swing low, took out other sides as well, like 1, 2, 3, 4. These are all in their own rights a swing low. I'm not going to go over that what that means right now because of the time. And from that taking of that swing low, we would expect a retracement into optimal trade entry, which in this case is over here. And there's two ways you can do this. You can either enter on the touch, where using the most uppermost valid entry, and then setting your most passive stop loss, and then of course likewise with the TP, which would be something like this. I don't like a 1 to 1.45, so then I would zoom in or I would adjust. For example, I can blindly just hope that price gets to the midpoint, which is a very actual plausible strategy, even though I say blindly, and that changes it to about 2.38, which is the same risk in terms of not risk, same stop loss, same TP, but I changed the risk to reward ratio by waiting. Maybe I want to get in at the optimal echelon, but it's valid until it gets filled. So this is the most upper place, but the likelihood of being triggered into the trade is less likely. But you have to account for that and accept that. But you do get that extra risk to ratio. Or you can get in early if you're confident. And then, of course, I personally don't take that 1.51 risk to ratios. I take 1 to 2s and above. So that could be your first entry. But another thing you can do, which is why I was talking about earlier, is a nesting theory, which is where you would wait for price to do the exact same pattern or execute the same pattern on a smaller time frame. So what do we see? This like GU, that higher high, that swing low being taken out. And what do we have? A retracement. So back then you could have probably got in from here. Probably not actually. I did say this earlier and it didn't come to optimal trade entry. Okay, we create another leg over here. Why is it a leg? Well, because it took out a lower low. It's relevant to the time frame. It's not the most extreme, like I was describing with the 15-minute, but it is an extreme. It's also an intermediate term high. Why? Because it filled these fair value gaps. When it fills a fair value gap, price shouldn't, in theory, come up to it again. Shouldn't. It's just some market structure work. Of course, it depends, and you have to be kind of relevant to the time frame. This one didn't fill this fair value gap at all. So if price comes up to this fair value gap, yes, it may take out intermediate term highs, but those intermediate term highs are not relevant to the zone it's reaching. So it's still plausible for price to go down. So I'm getting quite in depth, but it is what it is. Like if you're with me, you were with me. If you're not, then I'm sorry. You got to just, it just is what it is. So from this range to this range, we have this fair value gap. Price came up to it once, twice, dropped down, created a low low, taking out the swing low, creating an equal low here, and then a lower low down here. So in theory, you could go something like from here to here. I personally don't like this because it didn't really clear a clean lower low. And I also don't like this method of displacement because there's this a huge consolidation area right here. So I'm not a big fan of this. So in theory, though, you could enter it and try get down here, but I'd rather enter to a better location. That is what you would call a scalp. Okay, so that's enough waffling. I'm going to just speed analyze now. So I'm going to move a bit quicker than I was before. So as you can see here, we have multiple 15-minute fair value gaps, right? I don't know which one is going to be used. I don't, but there is a strategy I do use for figuring out when to enter. Wish I kind of remember the next idea. This swing low right here got taken out with displacement. We had a pullback into the optimal trade entry, which this would be a 5-minute fair value up. We didn't exactly reach this area, in all fairness. But we haven't reached it yet. Let's also back up the short-term ideology we had for DXY being bullish. Probably like 3.5 pips stop loss. Targeting here passively, which is already over 1 to 2.86. And then obviously, hopefully, it goes down here if I was to enter it. But again, it didn't come exactly to entry. I'm very strict personally. So I use the highest time frame possible, where that shows at least one area of imbalance. You could technically use smaller areas, but it's just a bit more finicky, which I don't like. So I like to use the highest time frame. So in this case, it's 3 minutes. So I would be waiting for price to come up here. This doesn't classify as an entry for me. So I want price to reach here, low hanging fruit, which is the bottom of it. And I mean, it's negligible from the top to the bottom in terms of what it really does for us. So I'll just enter on the bottom in this case. High time frames, it does matter a little bit more. And then I will set my stop loss to the first candlestick contributing to the fair value gap, which is over here. I think I got the candlestick wrong. It's actually this one right here. And then I'll add at least like 2 pips or something for spreads and whatnot. So this is the kind of trade I'll be looking for. Let's put like 5 NZD USD. Probably won't. Wait a second, I'm just editing things been messy. What's it called? Trading view. No, MetaTrader, sorry. Okay. Okay, what is this pair? NZ. Wait. What? Yo, that's crazy. On both pairs? Insane. I didn't even realize. Anyway, we'll keep looking. You get to a point though, after like when you lose so much in trading, you get to a point where missing out on the trade doesn't do anything for you. Like it doesn't, because you just know you're gonna get another opportunity. Like it was NFP 2 weeks ago. Last week there wasn't much. It was a bit weird, but this week there's been like so many opportunities. Yes, I've missed a couple. Yes, I haven't done the best diligence in some of them, but it's just confidence that price will repeat. And yeah, there's a great skill set you can apply. Not apply, but it's a great skill set to have. Okay, 1 hour does equal highs, and I don't like them. It's not clean enough. Same up here. I'm a big fan of GJ. Okay, there's equal highs here. Surprised to get to that. Okay. We created equal has basically here. I would expect that to get swept. It stays in high interest. Something like, okay, come down for a little bit, sweep, push up, and then something like this. That's what I'm expecting. Let's put this on watch list. I'm not trying to reanalyze this. So it means consolidating. If it wants to come up there, just keep on watch list. But that's the general idea I want to keep. We're definitely bullish. Let me see. Sorry, Daydream. I don't like that. That counts as sweep though. Actually does. Okay. I mean, I don't know if we're riding up here, I guess. If it's going to continue. Maybe of interest. Got half here. I would have wanted to. So I'm gonna explain this light blue horizontal lines. It's just me measuring kind of like a range of the peak that caused. Remember, our entry model has been triggered, which is just taking the swing low retracement, right, and it took out with that with displacement. So it took out the swing low with displacement, and our retracement is where we get in. So our entry model we would have been looking for entries right here based on just entry alone, but it will need a event horizon, event occurrence on a large time frame of the hourly and above. So I use the blue lines to mark it out, so I can drag it across to see if there's any kind of zone, maybe imbalance, liquidity sweep that occurred relevant to where price is currently at. And that green line, I think, does justice to kind of convey that point, because there was equal highs over here, and then of course we swept that. Took some time though, but yeah, we did. Don't like the way it's consolidated now. So what I'll then be looking for is, I guess, some form of liquidity being taken. I guess this that happened over here, maybe took that out. So you probably get maybe some small entries over here, and the target would be down here. So this would be one of the targets. There's a nice little leg here to here. Kind of already made that move. Took out this swing low here with this kind of leg from about here to here. And so we could potentially get into some. Yeah, there's a error imbalance. And yeah, that would be an entry potentially targeting overall here. Or just above here. Yeah, 4.5. I'm gonna leave this alone. Okay, so these are all the trades I like the most. So of the orders and order analysis, 1, 2, 3, 4, 5, 6, 7. 7 trades that I'm fairly interested in. What's this? This could be 4 min. But anyway, let's start from high. So this was the most recent one that we did, I think. Inactive anyway. It missed our entry by a couple of pips. We're very strict, right? So I don't enter even if it's close to the zone. It has to touch. Same with GU. We set the limit right on. This did not get us triggered in at 1.34193, which lines up with this. And price got to 1.34191. So by 0.00002, we missed out on the entry. And it is what it is. We do not enter. Sure, you could probably find another time frame, but oh wait. Is what it is. Remember, excuse me, this is around kind of a liquid, equilibrium. So I'll teach that another time. I was going to explain why I chose that 3-minute over the 5-minute, over the 15-minute, etc., etc. But I'll talk about that another time. For now, though, I don't know if I even want to be in that anymore. We'll look at the XY first. It just depends where the XY goes. Okay. Don't make a phone call. Hold up. Wait, how long was that muted for? Imagine I was muted the whole stream. I would cry. Okay, so that means that, let me double check now. Okay, so we were fine. Hold on. Oh yeah, I was meant to. Okay. Mm-mm-mm-mm-mm-mm. So what I'm looking at here is it's kind of like a divergence in the fact that G did create low low, traded below this low at least, and it's come back up. It looks like it's quite bearish. But on both of these, we don't have a touch. So I've deleted this sound limit orders just so you guys know. But because we don't have a touch, excuse me, because we don't have a touch, like I can't do anything. Now technically, on the 50, what time frame was it? On the 15-minute time frame, we have kind of respected this a little bit. But I don't care about this. Why? Because one, there's some higher, which tends to hold better value, but also because the ones that are higher are above that equilibrium right here. You can see this range. We don't need this one right here. Ow. Okay, so this one has come up to entry. So this one's, let me just hover over this before I explain that. So, I mean, there's kind of like an imbalance up here. and there's some up all the way up here, but I shouldn't cover there. So entry could be this. I think I might enter this, but on very low risk. Okay, so since we have the tag, we've got in. Let me check I'm not muted. Okay, I'm not muted. All right, so we got in here, and we'll be targeting down here. I think I put this one. No, I did G. Might be able to edit it maybe. Let me log this trade in front of me first. Post on the Telegram, the Telegram. I didn't put the right active trade. It's technically not active. All right, it's another one will be GU. Let's have a look at these real quick. I mean, I'm happy to close this. We just have that taking that swing low. We had the pullback. Does warrant potential drops. It's not all in a bit of an order block here, so okay. Bet. This wasn't reached. The area we're looking for. So okay, so what should we expect from this trade? So ideally, obviously, everyone wants to see price just instantly go to where you want it to go to as quick as possible, which is obviously ideal, but that really happens. So what tends to happen, and what do you have to be normal and accustomed to? So first of all, when you set your limit, especially when it's high like this, there's a higher chance of your price just reacting straight away. Why? Because you've chosen a very strong zone, and if you are correct about bias, this will be kind of the last area of defense in a way. So that kind of gives it a bit more value in a way, or strength, and all the time. But generally speaking, I mean, if you compare this idea to maybe entering a little bit lower, it's the same concept. For example, there's a fair value gap from here to here. If I was to enter on this low hanging fruit, it is just above equilibrium. It is valid. You would have had to weather a bit more storm. Let's just assume price goes immediately down. You would have to have weathered a bit more drawdown for the concept of the trade. Now, what does that mean, and what does that do? So for this specific trade, we got in quite high in terms of we got up at the fair value gap area. Hold on. I think I entered the wrong. Lot size, hold on. Okay, so because we entered up here, we should expect price to quite quickly react. So you do have that kind of advantage, but your stop loss is almost like a line. It's a line of which, obviously, when you add spreads and whatnot, it's a bit of a more grayer line. But the concept is this: if price reaches your stop loss, you don't want to be in a trade. And why do we not want to be in a trade if price comes up here? Well, there's nothing above it for price to react from. There's no fair value gap. There's no order block. There's nothing that I want from price up here, or I'm looking for price. Like there is an order block here, you could argue. And if price comes up here, we've violated that order block. And that's like our last line of defense. And if something gets past your last line of defense, well, at that point you got to think about retreating instead of trying to fight back. So that's kind of why when you're entering in this optimal trade entry area, your ideas is that, well, price shouldn't really come up to the stop loss, which is why you set your stop loss where it is. Price shouldn't get there. So you can expect some spikes like this. I would also, when you get in optimal trade entry, you should kind of see price react quite quickly towards your favor. And then, like I said, the spike is normal, but it could come up to a little bit. That's more so the volatility of the pair rather than price moving direction. I mean, if it's going towards your stop loss, it goes to your stop loss. It is what it is. When you enter the trade, you need to accept it hitting your stop loss. What does that mean? That means that you're psychologically prepared for price to go to stop. Not that you're expecting it, but you're prepared. Why? Because you don't want the next trade to be a revenge trade. You don't want to have a mentally affected mindset. You don't want to be entering trades, and if it hits your stop loss, you're not happy. Maybe you're risking too much, because it should be the cost of doing business is what we see losses as, and the cost of doing business is never looked at in a bad light. It's just the cost of doing business. When something is the cost of doing business, it's a cost because you're making more money. So it's either you're not profitable, your strategy is not good enough, you are not good enough in terms of how you're exercising the strategy. You're always good enough. Sorry, I don't mean to say that. But you're not doing well enough in terms of executing the strategy. Or 3, your mentality is not good. So anything that leads to you feeling the type of way in terms of the trade not going your way is mostly a you thing. It's mostly a you concept. It's mostly a you, not, I don't want to say problem, but it's the solutions with you. Is within you, right? So it's not you gotta look for who to mentor me out of this situation. No, you gotta just look inwards and deal with certain things yourself. And there's many different ways. If you're upset that you've lost so much money, you reduce your risk. If you're upset that you can't see as a cost of doing business because it keeps happening too much, maybe you need to change strategy or change understanding. If, I don't know, maybe you're just having a bad day, you just look up, you don't trade that day. Maybe something bad news, you heard some bad news or news you weren't expecting or wanting to hear, and you heard it. Okay, log off the markets, don't trade. I trade another day. The markets is here every day for every weekday, for the rest of as long as we know. So there's different ways to solve different issues, but the key is to accept or have the understanding that price can reach where it wants to reach. So I posted this into Telegram. I think this might be the only trade I take, and it will be wrong of me to say low risk because I risked normal amounts. So I'm just gonna put idea because that would be almost hypocritical of me. I mean, all the other kind of setups for me are behind schedule. Like this has a way to go. This has to create a low, or go down a little bit, then go up to sweep, and then displace downwards. There's a lot of steps for that to happen. So in my opinion, this is probably the better setup. And then GU's ahead, it then come up to the entry. So you just trade NZU and it lines up. It's the nested idea. So we'll set an alert down here, which would be the first area where we potentially take some profit, which should be a 1 to 2.8, which is not a bad amount. And we may even take out everything depending on how we reach and how we react to this area. We may take out half, we may take out everything, we may hold all of the trades to here if we believe and have confidence that price will reach all the way down here. The hourly closes, or the 30-minute, or the 30-minute and the hourly closing in about 9 minutes. So that'll be good to see. But I'm quite happy with this trade. And the main thing to do right now, since it's the only trade I think I'm going to enter, is to set an alert and hide the trade. Don't look at it. Don't look at it. You don't need to look at it. You set the value. If it goes to your stop loss, it goes to your stop loss. That's the highest point. You would have, if price gets there, you want to be out of the trade anyway. If it goes to TP, or if it gets to this level, you can then decide, okay, if it takes out this swing low, depending on how it takes it out, the distance, the X, Y, Z, it will determine if I want to stay in it. Okay, then we make that decision when the time happens. We don't need to make that decision right now. ADNZD, like I said, is far away, so maybe you can set a low over here. If price gets close to it, then I'll maybe want to start looking at it. Okay, for some reason, I should only have one alert. GU, we don't need. We're in NZU. delete all inactive, delete GU. Both of them on GU, interesting. Delete both of them. That's not deleted. Okay, it's deleted. Okay, next. So we set. Wait. Okay, yeah, this was the alert. ADNZD set one just about equilibrium. Can set a little bit lower. ADNZD CAD. I want to see the sweep happen first. Oops. USD. Keep an eye on it. This one again, similar to the others, like GBP USD. Just about didn't reach. Would have been a nice trade too. EURNZD kind of a little bit ahead. So yeah, after that, very simple. We close the markets. I'll probably log the trade later, and then yeah, and we're done just like that. Obviously, it took us an hour 15 minutes. We did do a bit of teaching, did analyze multiple pairs, looked for the best setup possible, traded the best one in our likeness in terms of what we like the most, and then from there, we like the one the most. We enter the trade, we risk the amount we want to risk, close the markets off of our screen, close the markets off of our phone, and then we go and do something else. We set the alerts, so we keep a device nearby that has the alerts. I have it on my phone, so that would obviously help me relevant to the looking at the trade. And guess what I'm going to do? I'm going to play some chess. And this is actually perfect time because I'm regarded to end my stream around 2:45. We went over by what, 8 minutes. But I'm going to show you just a little bit of chess. Log into my account. Okay, white to play. We can check the king like this. Obviously, this takes, but we could double on it. Check it like this, but this needs protection too. So if we check it anyhow, we can just take my king. Don't know if that's, rook, sorry. Don't know if that's worth it. This one checks and protects. Logically, that makes sense. You can't go here, can't go here, can't go here. Can go here. So the following move probably be this. You can go, cannot go here, cannot go here, cannot go here. I think it's just bam, bam. There we go. Black to play. So discover check. You can't move here. It's just simple as this because you can't defend both. There you go. So layered attack. I think layered was the word I was looking for in terms of nested. But yeah, well, nested makes more sense, right? So ideally you throw a check and then here, but he will probably attack my rook with this check, which is logical. And then if I was to bring this rook over, he'll take this. So is there another way to avoid that? We could check first with this. Or we could go here, he moves here, we then go here, and he's still forced on that same rank. And then we just mate with the other rook. Like to play well. Boom, boom to the queen. He goes, here we go. Why can't you just take, oh, you can't because I'm defending it with that. So when he goes there, wait, what? Oh, wait, maybe we check with the, he goes here. Oh, that should be like this. Then we go, I don't know, but I think that's the only way, right? And I hate how that's the first option. Okay, boom, boom, no. Okay, so you can barely move. You can only move to this square. Maybe I can get rid of these pawns. Oh no, but he will still be able to. Oh yeah, I can check. I think that's it. Nope, okay. Check him with this, but you can still go to this square. And we can go here and it's mate. Okay. So this thinks is to go here. You can block with this. You can obviously take. And you can go. You cannot go here anymore. Doesn't matter. Or it doesn't matter because it's neither of those options. That was foolproof. He goes here. What can he even do? Can't run away. He can't go here or here or here. We need to block with this. Just take, no? Then he can't defend again. Everything's protected. How on earth is it not that? Bus. Anyway, just wanted to show off that I can play chess. Peace. It's been CJIC. We'll catch you guys tomorrow. And day 96, I believe, complete. Or 97, one of the two. And I will see you guys tomorrow.